Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, let's get into it. Today we're going to talk about something that, let's be honest, confuses a ton of people. The S Corporation. It sounds all formal and complicated, but trust me, understanding this is one of the single most powerful things you can do to save a serious amount of money on your taxes. Okay, let's dive in.
So let's just dive right in with a question I hear all the time. It's this fear, right? You've worked hard, you look at your business bank account, and there's a nice chunk of money sitting there. But you're kind of scared to touch it. Like, is the IRS going to come knocking if you move it to your personal account? And then there's this other head scratcher. You get your personal tax return back from your accountant, and you see this big income number, but you're thinking, wait a minute, I never took that money. It's still in the business. It feels like you're paying tax on ghost money. Did your accountant mess up, like big time? Don't worry, we're going to clear up both of these mysteries. Okay, so to answer those questions, we've got to back up a little. We need to get on the same page about what an S Corp actually is. And spoiler alert, it is probably not what you think.
Okay, this is the single most important thing to get. An S Corp is not a type of company you form with your state. Think of it like this. It's a tax status. You have your LLC or your corporation, and you simply file a form with the IRS that says, hey, I want you to tax my company under this special set of rules. Those rules are found in Subchapter S of the tax code, and yep, that's where the S comes from. So why would you do that? What's the big deal with this tax choice? Well, the only difference between a regular old C Corp and an S Corp is how they handle taxes. But that one little difference, it is huge. It all comes down to this idea of being a pass-through entity.
And that right there, that's the S Corp's superpower. It's its whole reason for existing, really. It helps you avoid something every business owner hates: double taxation. See, with a regular C Corp, you get taxed twice. It's just as bad as it sounds. First, your company makes a profit, and wham, it pays corporate income tax. Then, when you take that leftover money home as a dividend, wham, you pay personal income tax on it all over again. It's a brutal 1-2 punch from the tax man. But the S Corp, it just sidesteps that whole mess. The company itself pays zero federal income tax. Instead, all that profit just flows through the business, kind of like it's invisible to the IRS at the corporate level, and lands directly on your personal tax return, and it only gets taxed once. So how does this actually happen? Well, there's this little form called a K-1. At the end of the year, it's basically a note to the IRS that says, hey, of all the money the company made, this slice of the pie belongs to this person. And here's the kicker. This happens whether you've moved a single dollar from the business account to your personal one or not. It's automatic. Okay, so now that we get this whole pass-through thing, you see where I'm going with this, right? Let's go back and finally solve those two big mysteries from the beginning. All right, mystery number 1. Can you take that money sitting in the S Corp bank account? Yes, absolutely, 100% yes. You can and you should. Why? Because as far as the IRS is concerned, you've already paid the income taxes on it. The second your company earned that dollar, it was already counted as your income. And that, of course, solves our second mystery. So, was your accountant wrong to put that income on your personal tax return even though you hadn't touched it? Nope, not at all. They did their job perfectly. Because that profit passes through automatically, they had to report it. So you see, the two mysteries were really just the same thing looked at from two different angles. All right, now that they've got the foundation down, let's get to the really good stuff. This is the strategy that everyone talks about when they talk about S Corps. So let's take our freelancer, Hong Gildong. Let's say their business made $100,000 in profit. Now, the IRS has one big rule here. As the owner who also works in the business, you have to pay yourself a reasonable salary. Basically, what would you pay someone else to do your job? For Hong Gildong, let's say that's a fair $40,000. So what about the other $60,000 of profit? Well, that part can be taken as a distribution. So why split it up like that? What's the difference? Here it is. Both your salary and your distribution get hit with regular income tax. No difference there. But only the salary gets hit with that nasty 15.3% payroll tax, for Social Security and Medicare. The distribution, it's completely free from that tax. And that is the whole game, right there. That $60,000 Hong Gildong takes as a distribution instead of salary, they don't pay that 15.3% on it. Do the math, that's over $9,000 in tax savings. in 1 year, just from this one move. This is exactly why people get so excited about S Corps.
But wait, there's more. Seriously, the savings do not stop there. Let's look at a few other awesome and kind of sneaky strategies you can use.
Okay, for starters, you can hire your kids, as long as they're doing real work, of course. You get a business deduction, and that income shifts to their super low tax bracket. Win-win. Next, your company can pay for your health insurance premiums. Boom, another business deduction. And for your home office, instead of just taking a simple deduction, you set up a formal plan where your S Corp reimburses you for the business portion of your home expenses. That reimbursement money comes to you completely tax-free.
Okay, but there's one more strategy that, honestly, it feels like cheating, but it's 100% legal. It's right there in the tax code for anyone to see.
It all comes down to the number 14. Remember that number.
Here's how it works. The tax code has this weird little rule that says if you rent your personal home out for 14 days or less in a year, you don't have to report any of that income. It's just tax-free. So what do? You have your S Corp rent your house from you for things like shareholder meetings or planning sessions. Your company pays you a fair rent for using the space, and it gets to write that off as a business expense. And you, that rental income you just got, it's 100% tax-free. I mean, come on, it's an amazing win-win.
So, let's zoom out for a second. What's the big takeaway here? An S Corp isn't just some boring tax form you file. It's a toolkit. It's a strategic plan to legally and smartly keep more of your own money. You dodge the double tax, you slash your payroll taxes, and you unlock all these powerful deductions that help you turn your business profits into personal wealth way more efficiently.
So, we've pulled back the curtain on what an S Corp really is. We've solved those confusing questions, and we've walked through some killer strategies. So I'll just leave you with this one question to think about. Now that you know the what and the how much could you be saving? Thanks for watching.